Hello and welcome to the J&J Pod, featuring a conversation between John Laxmi and John Laxmi. Today's focus will be Silicon Valley Bank.
Hey everyone. So I think we'll start with a brief introduction. First, the J&J Pod, right? That's not just representative of it being a podcast, but it's also a family pod. So this is my father and I. He's going to be the star of this episode, so I'm going to let him introduce himself, but I'll give a quick rundown on who I am. So I am currently the founder of Kismet. Kismet it's my company, but it's more than a company. It's a mission and a movement to help people with what I think the true epidemic is, loneliness. Yeah. So I solve for that through what I like to call the lost art of love and the science of connection. I am the fastest growing influencer in the female focused dating and love space. You can look at my handles below, follow me on social media before I get banned. But in terms of what's more relevant to today's conversation, Silicon Valley Bank, I have worked most recently at the CIA's venture arm, focused on human behavior technologies, more tied to my space. But before that, I've done stints at JP Morgan, the White House's National Economic Council, NBC News, NASA, AI startups, a whole range of things. And relevant to today's discussion, I was offered a role with SVB in their investment arm. And much to my thanks, I did not take that. But I will now pass it off to the man who's taught me everything I know, but not necessarily everything he knows, my father, John Laxmi.
Thank you, Jonathan. My name is Jon Laxmi, and I'm originally from India. I came to the United States in the late 70s. We really started in West Virginia. My wife and I lived in West Virginia for 6 years. I was the budget director for the state of West Virginia. I worked in state government for 6 years. I moved to the New York area in the early 80s, about the time Silicon Valley Bank was started. And I joined Morgan Stanley in New York and worked at Morgan Stanley and Citibank for about 15, 16 years, financing a number of infrastructure projects all around the world, power plants, roads, bridges, tunnels, and the kinds of things that we are all talking about today. And then I taught a course at New York University as an adjunct professor on capital markets for 5 years. And after that, 2005, I co-founded a private equity firm that invests in infrastructure assets called Alinda Capital Partners. And now I'm retired. I'm now a private investor. And people have been asking me about Silicon Valley Bank because of my background with in the banking sector and in finance. And so when I talk to Jonathan, he always asks me lots of questions, challenging questions, questions that I have to really pause and think about. So we thought that we would do this in this format so that we can invite even more questions from the audience and try to answer them in further podcasts.
Great. So yeah, Dad, I think I'll start with at least what's top of mind for me, right? We are bombarded with news, part of what ties to people having too much information in their lives, right? But we're seeing this recurrent theme. We're moving away from what was the Occupy Wall Street to now another potential banking crisis. Is this something we should be worried about? What is happening with Silicon Valley Bank?
Well, right now, we are now doing this on 15th of March. Today, the Silicon Valley Bank is in the hands of the government. And the government has taken over, essentially. I'm simplifying things, obviously. The government has taken it over, and they're desperately trying to find a new owner for this bank. And that's what happens when generally something very important, an important bank goes under, because the government wants to contain the damage to a small area and not let it spread. Unfortunately, as we'll discuss here, I think this is going to be much larger than just one bank, and it's even going beyond banking to many other sectors. But right now, Silicon Valley Bank has a lot of depositors very anxious. They don't know what's going to happen to their deposits. There are a number of startups who have borrowed money from this bank. They've got employees, payrolls to meet. They are very anxious, trying to see what's going to happen. And then because of Silicon Valley Bank being a fairly large bank in the stock market, all the other banks regional banks, even Charles Schwab, their stocks have been hit. And so there's a lot of buzz all around. And so this is the time to really sit down and see what happened, take stock of why this happened, how we can avoid it in the future. I think this can be avoided in the future. This was an avoidable mistake, and then try to learn from our past.
Okay. So on that note, then that's a good foundation to start with. How did SVB end up in this position? It seems like you're positioning them as a unique bank, right? That they've somehow accumulated a position in the market that's different from other banks. They're a large bank. So how have they gotten into this position? What is their market differentiation?
Let's start with the immediate costs of the problem. In the last year or so, Silicon Valley Bank made a very, very bad investment. They took the depositors' money, which the depositors can withdraw at any moment. Lots of it, hundreds of billions of dollars they have in deposits. They took over $100 billion of those depositors' funds and invested them, locked them up in long-term investments, which cannot be easily sold. They were good investments. They were U.S. Treasury bonds and other types of similar bonds that had fixed interest payments. Unfortunately, they did this about a year ago when interest rates were very low. So these bonds pay very low interest rate. Now, in the last 6 months, interest rates have been rising at the fastest rate ever in our history. And so those bonds which pay low interest rates are really of low value now. So they went to raise some money to pay these depositors who are withdrawing their money from the bank. And when they tried to sell the investments, they were facing big losses, and there was a run on the bank. Some depositors thought that all of the depositors might be lost. More depositors heard about it. We now live in a social media world where Twitter caused this fiasco to happen, some people say, because word spread around very quickly. And there was a run on the bank. But that is the immediate cost. But there is a lot more to this story. Okay. This is a very unique bank. Silicon Valley Bank is a big bank, but it's a 16th largest bank in America. But it's also a very unique bank. You see there, JP Morgan, Bank of America, Citibank, Wells Fargo, these are all the largest banks. And this, among the top 20 banks, only Silicon Valley Bank does what it does. None of the other banks does what Silicon Valley Bank does. And that is funding startups. The main business of Silicon Valley Bank is in California, where Silicon Valley is, where a lot of the entrepreneurs take risks and start new businesses. Silicon Valley Bank provides loans to these businesses so that they can get started and do their payroll and office rents and things like that. But these startups are really funded by rich venture capital companies. The venture capital companies are funded by institutional investors, big pension funds, big billionaires. So we could say that Silicon Valley Bank is really a bank of the billionaires. It was formed by the billionaires for the billionaires. None of the other banks are of this type. In all the other banks, people come and you and I can go and make a deposit there. We can borrow money from that bank. We can buy a car, a used car, or a house, whatever we can, with that money. But Silicon Valley Bank says to the borrowers, if you borrow money from us, you put that money back in the same bank. This is a circular, incestuous cycle. None of the other banks require this. Silicon Valley Bank says if you borrow money from our bank, you put the money back in our bank, and then guess what? The big investors, the billionaires who are funding those startups, their money is also in the same bank. So there's a concentrated bet in one single bank of one riskiest part of our economy is in this bank. None of the other banks have this concentrated risk profile. And this has gone on now for a long time. It's lucky that they didn't fall into this big problem earlier.
So I'm assuming then what you're saying, you're not trying to poo on the American innovation ecosystem, right? This isn't us trying to say Shark Tank or billionaires are bad. So where's the silver lining here? If you're saying this bank is serving and providing facilities that does found a lot of companies that do well and are enabling the products that we use every day, where's the line between managing its risk and suppressing innovation in America?
It's a good question. Yes, Silicon Valley is a place, well, America itself is the best place where people who want to take risks and get rewards from it can thrive. And there's nothing wrong with it. And these venture capitalists, the billionaires who fund these startups, they take risks. But what they are doing is they put some risk money into these startups, and then they tell those startups, go to this bank, this friendly bank that we have set up for you, and borrow money. These billionaires could fund all of the money that the startups need from their own funds. That would be fine. That's what we want to foster in this country and in the world, people to take the full risk. But these billionaires put some of their money as equity into these startups, and then they say, we have set up a bank, go to that bank and they'll give you a loan. Now, if you and I go to a bank and ask for a loan, we're not even going to be entertained. Long ago, when I was in West Virginia, I started my first job. I went to a store and bought a television set and asked for credit. The store manager said, fill out this application form. I filled it all out, and for a $200 television set. 2 days later, I go back to the store and he says, sorry, your credit got declined. I said, what? I have a government job. I have a steady paycheck. He said, you don't have a credit history. I said, if I don't have a credit card, how will I get a credit history? So I had to cajole the manager of the bank to give me a credit card. I got a $250 limit. I bought the television set. I paid my bills on time. Then 1 year later, my credit limit got increased to $500. That is how you and I, and a common man on the street, builds their credit history over a period of time. And even then, when we go to borrow larger sums of money to buy a used car or to buy a house, they say, put up 20% money yourself. Where is the value of the house? All of these questions. Now, the startups at Silicon Valley Bank, they just walk into this bank. Silicon Valley Bank just funds them simply because these startups are funded by these billionaires, by the same billionaires banks. What it does is it juices up the returns of these billionaires' investments in these startups. If they had put in all of the money themselves, they would get slightly lower returns. They would still be billionaires, by the way, right? This is a greed of a kind that is unnecessary. Now, we want to foster risk taking. We let them become billionaires. Instead of becoming a $30 billion person or $50 billion person, they might only have $20 billion. They are trying to juice up the returns by setting up a bank with insured deposits, insured by the government, and trying to profit from it. And that is simply the wrong business model. First of all, no lender should be lending to startups. Venture capitalists and these billionaires should be giving money to the startups. No single bank should be doing this anyway. And that's why in that list of banks, you don't see any other bank doing this. If this is such a good business, many other banks would have gotten into it, right? This is a private club, a billionaires club that's been set up for their own benefit. They benefit from it by juicing up the returns. And other banks don't want to get into it because it's a risky business. If this risk was dispersed among many other banks, we may have been better off.
I mean, that's a unique point. And there's a couple questions that I have here. So you decide how you want to break it up. But these several risks that you're mentioning, right? Almost that there's this old boys club, there's this concentration risk, and there's this duration mismatch where they're getting these deposits, they're investing it in these bonds that the value change. What do you think is the most poignant lesson, or what is the most important risk to be identified out of these that really caused what we're seeing today in the headlines?
Well, the important risk really is in distinguishing between good credit and bad credit. The businesses need to borrow money. Established businesses need to borrow money. Households need to borrow money for expenses, emergencies, and so forth. And governments need to borrow money. So we have a banking system to lend money to all of these legitimate borrowers. The startup world should not be borrowing money. That's a fundamental thing. Startups should be funded by what's called equity. Capital comes in two formats: equity, which takes risks; debt, which is loans from banks, where if a bank loans money to a startup, they can lose all that money. They got the downside, but they don't have the upside. These billionaires who are putting their money into these startups, they have all the upside. Okay, so this is a very important thing. Beyond that, we really have to also think about really the whole model of venture capital, where these billionaires are funding. They fund 1,000 startups, hoping that there'll be one big hit, a Google, a Meta, or a big company that makes them very rich. And in doing that, what they are doing is they are sending 999 bad startups to this bank to borrow money. The venture capitalists, the billionaires, will make huge amounts of money from that one big winner. But the bank that's lending to all of these startups, they only have the downside. This is something basically wrong as a society for us to structure.
To get into a bit of the nuance on what you're saying, as an extrapolation of that, does that mean that venture debt as a whole, as an instrument, is non-useful? Or, where's the line between a pond becoming a lake, right? At what point in a startup's history, or like your example of going to the store, how much credit history is required for there to be upside for a bank in terms of interest payments or valuing a company like venture capitalists try to do?
Well, excuse me. Let me take it. Venture debt is an oxymoron. Okay, ventures should not be borrowing money. Established businesses can borrow money. Our governments can borrow money because they have the ability to tax and repay the loan. And even there, we got to set limits. But venture debt is, startup. I'll give you an analogy. Another big problem society is facing these days is the big balloon college loans. College loans are given to students. They are like startups. They don't have any collateral. They don't have any income. They don't have any assets. They have a brain, and they're going to a university to get a degree. And we give them a loan. And then we hope that they will pay them back. But the universities that are supposed to give them an education, they're not on the hook. So they get out of the universities, they come out in the real world. Many of them don't have necessarily the skills that the real world needs. If they don't have income, those college loans go bad. And then we blame the borrower, the students. Now they cannot get a job, and they're now on the hook for loans. Now, as an experiment, let's think about a society where if we want to really subsidize college education, what if we give the loan to the universities directly, make college education free? We'll start seeing that the universities become suddenly very frugal, very focused, right? These are enterprises. Universities are enterprises where they build big fancy stadiums, fancy dormitories, and then the administrators and the professors get rich from these college loans, and the students are shortchanged. Similarly, in this startup ecosystem, there are innocent people who are hurt. The employees who work in these startups, they're not really the entrepreneurs. The employees are going to lose jobs as a result of this, right? They are not going to be able to pay rent in San Francisco and places where there are high rent. The landlords are not going to get rent, so they're going to default, right? It's going to cascade into the system wide into a problem where we've been talking about a recession the last few months. This is going to hasten that recession, make the recession even deeper. So what we thought is a specialist bank that's just catering to a startup world really is now going to really set in motion a much wider problem that's going to be affecting all of us, the man on the street. So we got to really take note of this and say, enough is enough. Now they're talking about a bailout and all that. I don't know if you want to really get into that.
Well, I mean, I think what we're talking about does betray some underpinnings, or at least some of the sounds that are reminiscent of 2009, the housing crisis, right? So when you think about TARP and the bailout, we are hearing people from both sides of the aisle, right? I love Bill Ackman, but Bill Ackman is supporting FDIC above 250K bailouts, right? He doesn't want the employees, the payroll to get shafted, saying that this will filter down to regional banks. And of course, on the other side of the aisle, Carl Icahn, Citadel's Ken Griffin, right? They're saying this is a moral hazard. So is this the start of something like the financial crisis? Is this a repeat? And is this on a deeper level, on an almost existential level, is this human nature, right? Spider-Man's quote, with great power comes great responsibility, but if you give people power, they're prone to abuse it.
Well, it's not only a repeat of what happened in the financial crisis, it's a worse crisis than the financial crisis, in my opinion, because in the financial crisis, we saw a big bubble around the housing market. The housing market involves ordinary people, large numbers of people were borrowing money for houses. They overpaid for those houses. They couldn't pay the mortgage payments. And a large number of lenders were involved in that. Lehman Brothers, of course, went under, and some big banks went under, but there's now large numbers of savings and loans and the other lenders who lent to the market. Here we have a concentrated bet on one big bank with over $200 billion of assets, causing a problem, nationwide problem, economy-wide problem. And it also betrays, as you rightly pointed out, not just human nature, but our tendency, particularly an American tendency, I would say, although you can see some of it in other parts of the world as well, we always go to excesses. We let bubbles build. We knew that this was happening because we knew during the last 2-3 years, the stock market was booming. And what stocks were booming? These technology stocks were booming. Now, there are some good technology stocks that have brought us very good products and services. Google we can use for search and maps and all the stuff. That's fine. But we got lots and lots of other company. Every app is a company that could go to the stock market and raise hundreds of millions of dollars. Excesses were building up, again, fostered by Wall Street, which took a lot of companies public. And believe it or not, in the last 2-3 years, getting slightly technical, there were simply blind pools of money that Wall Street underwrote. These are called SPACs, special purpose acquisition companies, they are called. So the big investment banks, they would simply take an entrepreneur and say, you want to buy a company at some point? We'll get you $100 million. They'll go and list in the stock exchange a company which has no business yet, which got somebody with the intention of buying a company. They don't even tell in the prospectus what they're going to buy. These excesses were allowed to happen, okay? And when we go into this type of excess, we are going to get the same kind of result. In technology itself, we could see in the technology, we get artificial intelligence and wonderful things from technology. But I think technology has given us social media. We saw all the polarization in society that has happened in the last 10 years as a result of it. The isolation and the loneliness that you're dealing with in your company are the result of technology. We have to be much more discriminating in what we do, what we use technology for, what we use capital for, what we use government for. And in terms of, you mentioned Bill Ackman and others, saying we should bail this bank out because other banks may fail. I say this particular bank should not be bailed out because this particular bank is a billionaires club. This particular bank's shareholders can take the risk. They took the risk for 40 years. And the reason they continued for these 40 years is because these 40 years have seen some of the best times in the last century. If you look at the last 40 years, interest rates have kept declining for 40 years consistently, as this chart shows. By the way, Silicon Valley Bank was set up in 1983. In the chart you see, that was the peak of interest rates. Believe it or not, Silicon Valley Bank was set up by two guys over a poker game. I'm not making it up. Okay, you can look it up. Two guys in 1983 set up this bank. And since then, interest rates have been declining steadily. The economy grew well in the 80s. Then in the 1990s, we got into the dot-com bubble. But the economy grew, interest rates kept on declining. Everybody could borrow more freely. That party is over. That 40-year party is over now. Now interest rates are going up. Our government debt is going up to extraordinary levels. We are now financing and indirectly getting into a war in Ukraine. We have to really hit the pause button. Life as we have have led in the last 40 years have included large excesses, indulgences, and we got to really pause and say, we got to discipline ourselves, I think.
Yeah, Dad. So we're coming up on, we have about 5 minutes left where I'd like to ask probably maybe 2 more questions to get your thoughts on this. And thanks for giving the history overlay of how good times can build weak institutions and weak people and individuals. But I'd like to know, give me a sense when we're seeing this pitting, almost this philosophical question around it being a moral hazard, supporting bad actors, or mitigating the exuberance of how capitalism in its purest form should be. What do you think is, to almost give a prescription, right? What should be the outcome of this? How would you see this playing out? And also, more realistically, what is the probable outcome, right? Because we saw Biden give his speech on how he's going to take care of this. So in your line between the two, where's the distance between what should happen and what is probably happening and going to happen?
Well, what should happen is that the moral hazard that you mentioned is a very important principle. When we bail out bad actors, we encourage more risk-taking, reckless behavior. So what should happen here is that those who took the risks, billionaires who put money into this bank knowing that it was not insured, they should take the risk if their deposits cannot be repaid on time. I think that eventually a custodian can take over this bank and let those long-term bonds that they invested in run out and then pay the depositors back. The billionaires can wait. Mostly 80% of the deposits of this bank are from the same ecosystem. The people who really need to be bailed out and helped are the employees of the startups. They are losing their jobs in the immediate vicinity in San Francisco and in the Bay Area, where Silicon Valley is, and in a few other places. People with real hardships need to be helped. Unfortunately, I think what's going to happen really is we are going to look at the big institution and try to save them. And what's going to happen is that people are going to say, whew, luckily this got saved. In my mind, I think the Silicon Valley Bank should be eventually shut down. There is no need for a bank to lend to startups.
So one question on the flip side of that, we talk about the hardships of these employees. Is this also an unfortunate but necessary correction in overinflated valuations, the bubble that we've seen in tech stocks? It seems like there's a movement from the Occupy Wall Street to Occupy Big Tech, big government, right? There's a shift and concentration of capital to the FANG companies. So is this a good wake-up call, not just for venture capitalists and billionaires, but also for startups to say, hey, most startup ideas, they are going to be tough. You've seen Shark Tank, right? Not every idea becomes a billion-dollar success, and that's part of American grit, part of innovation. Do you think that that's a necessary tribulation that we need to go through as a country, as a nation, as individuals?
Absolutely essential. I think that we have the country, we are the country that leads the world in innovation, but we are also the country that takes enormous risks with everything that we do. And risk takers are actually willing to face the risks. And so what we should do is to correct the business model of the venture capital industry, and debt should not be allowed into the early stage companies. Debt should only be for established companies. And we should also then think about other spheres where similar bubbles are building up. I mentioned college loans, government debt. We keep kicking the can down the road. Our government keeps on borrowing trillion after trillion dollars. Yes, we can print money, but sometime or the other, we got to face the music. All the governments, big governments in Europe and Japan and the United States, the 3 big engines of the world, they have all been printing money. And then what did it lead to? So then somebody else comes up with a cryptocurrency. They say printed money by the government is not valuable anymore, so we've got to have cryptocurrency. That's another oxymoron, in my opinion. Crypto means secret. Currency, do we want our currency to be enshrouded in secrecy? We want more transparency. We want more honesty. We want more soul searching. I think that's really the lesson of this.
And give me your now quick 30-second final take, right? I've never banked with SVB. I'm not a billionaire yet, right? For the average person who's thinking about what they can do, is this vote in a different government? This seems like a cluster of a lot of different parties. Is this not banking with specifically banks that are in this space? Is this being more scrupulous about what types of companies to work with and what types of products to buy? What can I do as an individual?
Well, as individuals, I think all of us should be always afraid of debt. Okay, regardless of which bank we borrow from. Shakespeare wrote in Hamlet, neither a borrower nor lender be. Both are really hazardous. Don't be a borrower, don't be a lender. Silicon Valley Bank ended up being both a borrower and a lender. Their borrowers were also their lenders, their depositors, right? So what we need to be is become much more conservative in our outlook generally, because life is hard. We got to put in the real work before we can enjoy the fruits of our labor. In personal life, we need to become more responsible. We need to hold banks accountable, Wall Street accountable, technology companies accountable, and ultimately our governments accountable too. So it doesn't matter whether you vote Democratic or Republican, call them to explain what they are doing with this bank and with all the other issues that we are facing. Hold them accountable.
Thanks, Dad. It's a great talk, as always.
Thank you.